So, Gunnar, thank you very much indeed for coming before the committee this morning, and I'm sure this is the start of a long and productive relationship and just the odd questioning session. And you'll notice a few changed faces from your last committee appearance. I want to start on the question of 20 years of independence, which obviously is something that the bank marked in September, and wondered if you might just share with us what you think are the most important threats to Bank of England independence today, what you are considering sort of guarding against, if you like.
Okay. Well, thank you, Chair, and say hello to new members and previous members and returning members. Yes, I think it was quite helpful to take a step back and look at the track record over the course of the last 20 years of operational independence from monetary policy. So first thing is to re-emphasize that, and we forget that at our peril. It's Parliament that decides what the objective is. It's in the Bank of England Act, which is a price stability objective. Then it's refined by the annual remit letter from the Chancellor. And then the bank has operational independence, as you know, in order to achieve that inflation target. The first threat is one that developed over the course of the last 2 decades, in particular in the run-up to the crisis, which is thinking that monetary policy can do more than it can. Monetary policy is effective for achieving its sole objective, or its primary objective, which is the inflation target. It can be helpful in contributing to its secondary objective, which is to support the government's economic policy, strong, sustainable, balanced growth, as currently defined. But it is not the principal instrument for financial stability. So a focus on and this is one of the lessons. It's not unique to the United Kingdom, but one of the lessons in the run-up to the crisis was a healthy focus on price stability became a somewhat dangerous distraction, a distraction away from issues of financial stability. So the reforms that brought in the other responsibilities for the Bank of England around the financial sector, macroprudential safety and soundness, have been complementary to the inflation target and that aspect of independence. But that brings, those 2 points bring me to a broader point, which is that what's crucial is that we focus on what the bank can and can't do. We can contribute to price stability, contribute to financial stability. Our principal targets are not, our actions have implications for other variables in the economy, other outcomes in the economy, but those are not the objectives of the bank. So while we can contribute to an understanding of those, we are neither empowered to, nor should we, swing those policy levers around to try to achieve, for example, distributional outcomes. We have very little impact on productivity over the long run, sole for the contribution of if we get it wrong, either in price or financial stability terms, we can be detrimental to productivity, but we can contribute to, I would summarize by saying, we are not the determinants of long-run prosperity in the United Kingdom. We provide some of the important foundations for that, but the key determinants, certainly from a policy perspective, are determined by yourselves and your colleagues in Parliament.
I wanted to turn to look at inflation now, which obviously is in the news this morning. You talked in your opening remarks in September, you said high inflation hurts the least well-off in society the most. It distorts price signals, inhibits investment and ultimately damages the economy's productive capacity. But you went on to say equally deflation imperils growth and employment and in the extreme leads to financial ruin and economic collapse. Now this morning, since the committee started, we've obviously had the latest September CPI inflation figure, which has reached 3%. So that does mean you're now 0.1% away from having to write to the Chancellor to explain the deviation from the target. And that will be your 9th letter for target breaches, if you have to write it in the future. So do you think the bank is doing enough to keep inflation to target? Do you think you'll be writing another letter soon? And if so, what will you be saying in that letter?
Well, the first thing, I'll take the second part of your question first, which is I think it's more likely than not that I will be writing on behalf of the MPC a letter to the Chancellor. We expect that inflation will peak in around the October-November figures, and so peaking potentially above the 3% level. I think when we take a step back and look at why previous letters have been written since my time on the committee, and recognizing that the initial phase of my time on the committee I will have inherited the very good decisions made by the MPC prior to my arrival. In other words, there are lags, as you know, in monetary policy, so the outcomes, at least in the first year or so, largely determined by previous actions. The principal reasons behind inflation being very low initially in the run-up to in 2014, 2015 was very strong run-up in sterling, and very low the level effects on a variety of energy prices which flowed through. So these are shocks that the bank can choose to look through, and it has to justify why it would look through, and the justifications, and we can go into them if you want, are detailed in this, not just in the inflation report, but in the letters that were written to the Chancellor. The inflation rising potentially above the 3% level in coming months is something that we have anticipated. We had signaled, in fact, prior to the referendum that we felt that the event of the vote to leave, one of the adjustment mechanisms would be through sterling. And this is a quote, we expected sterling to fall sharply. It did. That passes through to prices. In fact, the UK has one of the highest degrees of exchange rate pass-through to consumer prices amongst the advanced economies, in part because it's a very open economy, but there are other reasons behind it. And as a consequence, we faced a trade-off, and we still face a trade-off between having inflation above target and the need to support, or the desirability, and this goes to a secondary objective of supporting jobs and activity. Can I make one other point? I'll hand back. I don't want to go on too long. Is that what matters is inflation.
We were admiring you.
It's good to see you, Mr.
I'm under pressure to make sure that not only questions are short, but answers are short too.
I understand. You have other business. But the point I want to make is when we look at that trade-off, and I'm sure we'll get into this, of course, it's over the policy horizon. The initial rise, the spike in inflation with sterling's depreciation, there's not much monetary policy can do about that. Oil prices have gone up recently. There's not much monetary policy can do about that. But what we have to look at is inflation and output 18, 24, 36 months out. And that's where we focus our attention, because monetary policy can definitely affect nominal variables and real variables, in other words, jobs and growth, at that horizon. And that's the trade-off we're looking at as a committee in judging what's the right stance of policy going forward.
We're going to go on. I know colleagues are going to have detailed questions on monetary policy, so I won't go on too long on this, but you talked about inflation peaking in October, and others have said the same thing. What is it at the moment that leads you to think that October may be a peak and then we might see a reduction towards the end of the year? Or is it possible to say that yet? Well,
we will have an updated forecast at the first week of November, so we'll give our updated thinking. We're just starting that process now. But the principal reason is because the main reason, in fact, the sole reason why inflation has gone up as much as it has been the depreciation of sterling. And from past history, past experience, we have a sense of the time path of that pass-through into inflation. And then once you roll forward from the initial big depreciation, you have a so-called level effect. Now, the point I do want to make, and I'll finish on this, which is that in general, if you think about pass-through in the United Kingdom of an exchange rate move, think broad brush, you get 40% of the move in the first year, 40% in the second, and 20% in the third. And that last bit is relevant because if you have a very big move in the currency, which is what we've had, is you still have an effect out on year 3. In other words, something that's pushing up. And in previous forecasts, including the August forecast, it has been keeping inflation above target even out at year 3.
Thank you. Before we move on, I wanted just to ask you about a story that appeared in the front page of the Telegraph, the business section, yesterday, about the ONS change on their I think they were looking, they were redoing their numbers on the UK's international investment position. And I just wondered whether the ONS's revision to the net international investment position had affected the bank's analysis of the economy. I think you previously said the UK is relying on the kindness of strangers in reference to our current account and international investment deficits, but this rather dramatic change in the ONS's numbers, affects perhaps how kind strangers have been or continue to be.
Right. We had expected that the current account, which previously was 3.4% deficit, we had expected that it would be revised up. So directionally, we expected something. We obviously, we're not right on top of the numbers as the ONS. That's the ONS's job. So directionally expected it. Current account moving up to 4.5% is consistent with what the FBC's previously expressed concerns about some of the risks around the current account deficit. I would make one point, though, and this is in the realm of financial policy, as financial stability as opposed to monetary policy, which is that if you look at the UK's net international investment position, so the stock as opposed to the flow, it is actually quite healthy. We do a mark-to-market, as helped by the ONS, a mark-to-market calculation of that net international investment position, and it is, even on the revised figures, on the order of 70% of GDP. And that, in part, is in part helped by the fact that the structure of the liabilities, the UK owes a lot in sterling and owns a lot in foreign currency assets. And a lot of what it owes, not all of it, but a lot of what it owes is low-yielding gilts, and then a lot of what it owns is higher-yielding real property, real investments. And so with the depreciation, you get a positive move. And that is one of the mitigants to the risks around the current account. But it is still a sizable deficit. I said that was going to be the last point, but I want to make one other point because it's important, which is that the sustainable level of that deficit will in part be determined by the nature of the ultimate trade agreement with trade investment agreement with the European Union.
Okay, we will come back to that, I have no doubt. Alistair.
Thank you, Chairman. Governor, you said a few moments ago that with the referendum result, you expected sterling to drop. So would you agree with me that that was the time to raise interest rates by 0.25% to support the pound rather than to drop them by 0.25%? And effectively that drop of 0.25% on the Brexit vote was unnecessary?
No, I wouldn't agree at all. The movement in the pound the pound has largely been determined by the prospects for that trade and investment deal with the European Union, and has fluctuated largely around both the expectations of the scale of the deal and the timing of that deal. And we saw a movement in the run-up to the referendum. We saw a sharp movement post the referendum, and those movements are based on the markets, and it doesn't mean the market's right, but if you take the market as a whole, the market's judgment about what Brexit will mean for a period of time. I'm not making a personal judgment about the fullness of time, but for a period of time, to real incomes in this country and relative real incomes, UK versus rest of world. And in relative terms, the market's judgment is that real incomes would be lower than they otherwise would be. So that is a real factor that's driven the exchange rate. Now, the bank, from a monetary policy perspective, is faced with what is termed under the remit as an exceptional circumstance. You have a fundamental change with the trading relationship with our largest trading partner, prospective other changes which will come because of that, in other words, other reforms domestically and other trade deals with other partners around the world for those prospective changes. But you have that fundamental real shock, which is leading to inflation going to be above target for a period of time, protracted period of time. And the question that's faced with us is, do we support adjustment in the economy during that period of time? And the judgment of the committee, unanimous judgment of the committee, was yes. And we had the August package, which has supported the economy in the last 14 months.
But you talk about the fundamental shock. I mean, in good times, we should prepare for bad. And I would put it to you that at 0.25% bank rate, we haven't got much left in the armoury. And by moving interest rates up in line with inflation, broadly matching inflation, we would have, for the next recession, when it should come, or the next financial shock when it should come, we would have more flexibility in being able to manage the situation. At the moment, we've got very little left.
I'm afraid we're 0 for 2 on agreement, because the path of policy is designed to achieve a sustainable return of inflation to target. In those circumstances, for the last 14 months, up to and including our last decision in September, the view of the committee was that the stance has been appropriate. Monetary policy is stimulative, as you know, at this time. It is the only macro policy that is stimulative. Fiscal policy is still restrictive. And there are a variety of headwinds going against this economy. Now, the judgment has to be about balancing that trade-off. When do we want to get inflation back to target versus the relative amount of support? And that's why having made progress over the course of the last 14 months, having created the economy having created almost 400,000 jobs, and you know the figures, in terms of overall employment, having used up more spare capacity, having seen some evidence of early evidence of building domestic pressures, the judgment of the majority of the committee is that some raise in interest rates in coming months may be appropriate in order to have that sustainability. My point being that the trade-off has moved away. That's different, and this is where I'm slightly disagreeing with you, that's different than an idea of raising rates now so we can cut them later if the economy needs support. That's not consistent with achieving the target. Building a war chest in interest rate terms for a potential future shock isn't staying on point in terms of the inflation target, nor is it appropriate, in my judgment, is it appropriate or necessary given that policy can move quite nimbly if required.
We'll agree to differ.
Charlie, do you have anything else you wanted to add on this?
Not an interest.
Kit, do you want to talk about quantitative easing, but also you want to go on to talk about
Well, I just wanted to, I'll come in on the QE later.
Yeah,
if I can.
okay.
I just wanted to ask you about the current status on clearing.
Yes.
It seems that much of the city has reconciled itself to Brexit. Indeed, pleasingly, there's a growing opinion that it might actually be beneficial, recognising that it's not a zero-sum game. But there is still quite a lot of anxiety about clearing. Now, you've been on record most recently in your Mansion House speech ringing alarm bells about the threat to stability, fragmentation of liquidity, all the rest of it, the efficiency and the extra cost that will be for business. What physical progress are you making with our European partners?
Well, the first thing I'll say is, and thank you for referencing the Mansion House speech, because I think it summarizes the headlines in terms of the bank's views. And I just underscore, I think you know this, Mr. Malthouse, but those costs of fragmenting clearing, particularly clearing of interest rate swaps, would be principally borne by the European real economy, and they are considerable. An implementation of a so-called location policy in its purest form would, in our judgment, raise clearing costs in euros for euro interest rate swaps by at least 1 basis point and potentially up to 3 basis points. It doesn't sound like much, but given the underlying volumes, it's 20 billion euros per basis point. Yeah. And again, that's borne by the real economy ultimately in Europe. So we don't see that as a desirable outcome. The impact on the UK, on sterling interest rate clearing, on US dollar interest rate clearing, on yen interest rate clearing, Canadian dollar for that matter, would be quite marginal. There would be some impact, but it wouldn't be significant. So just so that we're clear on that. In terms of progress, as you can appreciate, the negotiations are a matter for the government. So we are not, the Bank of England is not engaged in negotiations about any aspect of the future partnership, and this would fall under the arrangements of the future partnership. We can comment because we're still a member of the European Union, we can comment on the proposals of the Commission. We have.
These are the June proposals.
The June proposals,
I mean,
exactly.
Do those look like an act of aggression to
you?
It's
the June proposal. There's two broad elements to the June proposals. There is one which is a location policy type approach with various tiers, and another which emphasizes a cooperative supervisory relationship which looks very much like something we would advocate and something that the Bank of England actively participates with, whether it's with the Canadian authorities or the U.S. authorities. We sat down with this, myself and colleagues with the CFTC and the SEC when we were in Washington last week on exactly that relationship, the existing relationship with the Americans. So the Commission's proposals, and we have said that we welcome that aspect of the Commission's proposal.
But does
that
aspect of the Commission's proposals allow them to discriminate against London? I mean, obviously,
well,
there's euro clearing in New York because there's this mutual recognition agreement. Could they deny that to us and therefore discriminate against London?
I would, in terms of the Commission proposal, two aspects. Location policy, we don't see the merits of that. The other, supervisory cooperation, a broad way I would term it, enhanced information sharing, I very much prefer to see the glass half full. That's the way forward for handling very important clearing entities such as those resident in London. And that's what we would look to work on, the collective we, through the government and the Bank of England supporting and the relevant EU authorities. And I would note as well, you know this, but the relevant EU authorities have been expanded with the proposal to ESMA, and importantly the ECB, which and there's a logic to that. So there's much to like about the broad Commission proposal, with one big caveat with which you're familiar.
I mean, you're on the, I think you're on the Council of the ECB, aren't you?
I'm on the General Council of the ECB. Which,
so that's a collection of all you central bankers from the EU.
Yes.
What is the general consensus? I mean, you've talked very compellingly about the threat to financial stability of this issue. That's not just internally to the EU, that's a general shock to financial stability in this hemisphere. Are they apprised of that? Do they get it? Is there a consensus on the Council that you're right?
I think that there is a learning process underway on I'm testifying, so I'm giving you my straight answer. I think there's a learning process on the scale of some of the financial stability issues. I'll give you an example which is related to this, which is, it's not about clearing per se, but it relates to derivative contracts, which could be bilateral, bilaterally cleared as opposed to centrally cleared. There are tens of thousands. There's, at last count, 40,000 derivative trades, pairs between different counterparties that are UK resident or EU 27 resident. The continuity of those contracts post-Brexit for a number of events, life events, which go everything from compression to rollover to exercise of options, substitution of collateral, big things in the mechanics of derivative world. It is pretty clear that those contracts don't continue to be valid, if I can put it that way.
Yeah.
They're valid if nothing changes, if they just run off, but if anything changes, and something always changes, then they wouldn't be. That can only be solved by both sides. It's something unilaterally the UK can do to solve it, nor something unilateral that the EU 27 can do to solve it. That's an issue, and we have surfaced that. We've done that publicly in the last few months, in part because we've been working to find other solutions which don't work. The market can't novate all these contracts in time. And so that's an area, I'm using that as an important example, that's an area where we do have to work on it. And I think that had been underappreciated in the continent.
So you would like, presumably, the go-ahead from whoever because you've done this before, right? When you were Governor of the Central Bank of Canada, you agreed a supervisory arrangement with the UK to allow clearing of Canadian dollars here, right?
Yeah.
So you would like to get the go-ahead from the UK government and whoever has to push the green button in Europe to start those conversations to come up with that regulatory framework.
We would like to get the go-ahead, or to have the right interlocutors from the UK government to have the go-ahead to have those discussions supported by us in technical sense. I think it's clear the UK government would like to have the go-ahead to have those discussions as well. But I think
presumably you're lobbying when you go over to your meetings with the ECB Council, you're lobbying for them to put pressure on.
Yeah, I mean, I'm not sure central bankers lobby, but we have full and frank objective, evidence-based discussions.
Yeah, okay.
And so I'm bringing more evidence to the table.
All right, we'll take that as code. Say the EU decides to go for what I guess you would characterise as this kind of self-harming option, adding this additional cost to their own industries. They go for this location policy. They find some way to, in their own legal terms, to discriminate against London, but let New York carry on, the rest of it. What is the stop to international counterparties deciding to clear whatever currencies they want in London?
Well, it's difficult to design. Certainly, if I'm a UK-based bank, whether it's a UK headquartered bank or a foreign bank that has its operations, its subsidiary in London or branch in London for that matter, if it's trading with a Japanese bank, a Canadian bank, an American bank, and it wants to clear euros in London, it can clear euros in London. So
and what proportion?
So sort of policy of currency nationalism is not goes to that. The proportion of it's a low teen proportion in terms of European counterparty to European counterparty of the overall bucket that is of swaps cleared in London. So it's forgive me, I can write back. It's 12 or 14%. It's referenced in the speech, but remember, for the sake of argument, let's say 14%. Just so I'm giving the high estimate, which means that obviously 86% of everything else is there, which is why the economics of what's left, it's not quite as good, but it's still pretty compelling.
Okay.
And as you know, but just for the record, what the economics are driven, the more collateral you have and the more diversification you have by way of currency and others, the better the economics are in terms of centrally cleared.
So what you're saying is that if a European-based institution attempted to clear euros in London, so the EU would have to find some way to punish that institution.
Well, it would. You have to. You need to clear through an authorized clearinghouse, and that is done in part to protect. The institution should make its own judgment about the creditworthiness of the clearinghouse, but it's done in part to protect. So if it's an unauthorized clearing, you can go anywhere from capital penalties or other penalties. So there's ways to do it. The question is the logic of it, and we would suggest that it just doesn't make sense for European car manufacturers, European pension funds, European banks, ultimately European individuals to pay tens and tens of billions of euros in extra costs for a service that is done properly in London, for which there can be a close supervisory cooperative arrangement, information sharing, and that works and is ultimately, I'll finish with this, which is consistent with the objectives of the G20 and the FSB, including all the European members of the G20 and FSB, to clear derivatives in this way, because that's one of the ways to learn the lessons of the last financial crisis, or address the issues of the last financial crisis.
So you're champing at the bit to get going?
We're certainly, yes, and I would say this as well. We are absolutely ready. We have worked this out to deep detail. Yeah.
Okay, thank you.
Thank you. I'm going to bring in Stuart.
Morning, Governor, and apologies for not being here for the end of this session. Sam Woods from the PRA has criticised the state of contingency planning among some EEA firms with branches in the UK. He said that we're having to push the inbounds that EEA and EU firms exercising passport rights to move on with their thinking. Do you believe they're responding to the calls to develop their planning? And can you shed any light on why firms supervised by the PRA, or of the firms supervised by the PRA, this group of inbound EEA and EU banks are the least well prepared for no deal?
Yeah. At first, I obviously subscribe to the comments that Mr. Woods made. We work together on the PRC and closely on all these Brexit issues. And it's absolutely correct that there has been a difference in terms of the depth, level of sophistication and advancement of contingency planning of outbound firms versus inbound firms, which was one of the main reasons why Mr. Woods, wrote to all of the firms to get their contingency plans, and we're working more closely with the inbound ones. To some extent, it's a matter of speculation, but I would say, based on some conversations, there's been two assumptions. One has been that are of interest, let's put it that way. One has been that there has been some assumption by inbound firms that there will be some form of transition arrangement put in place, and therefore the urgency of this type of planning was less important, and perhaps an implicit assumption that they would be grandfathered effectively if they were operating as branches here previously under European passporting. I think they now understand that the latter isn't necessarily going to be the case, and we'll have more to say about that in due course. In terms of the presumption on transition, and I think it could go back a bit to Mr. Malthouse's questions around derivatives. I think it's interesting. There is some presumption on. I would observe that we are preparing, as we should, for the possibility of a hard exit, if I'm allowed to use that term, but a hard exit without a transition. Okay, I'll substitute that. But a hard exit without any transition period. So we're doing all those preparations for that. There has been much less of that done in the European Union, including by the member firms.
That's interesting. I would have assumed, just to digress, that transition for complex financial institutions would require to be over a considerable time frame.
Yeah.
So is your judgment that they're assuming this won't be a 1 year or 2 year, but this would be a prolonged transition, at least in their minds, given how long, for example, it's taken for Solvency II to be bottomed out? Is that? Do you think that's the judgment in their minds?
I'd probably limit my the degree to which I try to interpret other people's thoughts. I think that it is, I'll state this in my opinion, it is absolutely in the interests of the EU 27 to have a transition agreement. And also in my judgment, given the scale and the complexity of these issues as they affect the EU 27, that there will ultimately be a transition agreement. There's a very limited amount of time between now and there's very limited amount of time as pertains to your question between now and the end of March 2019 to transition large, complex financial institutions and activities. And you referenced Solvency II. If one thinks about the implementation of Basel III, agreed back in 2011, implemented fully 2019. We have extensive experience, and I think we're alone in the current members of the EU having this experience. We have extensive experience, and expensive experience, I might say as well, of managing the transition of for individual firms of various derivative and risk activities from one jurisdiction back into the UK. That tends to take 2 to 4 years. We're talking about, potentially, depending on the agreement, a substantial proportion of the activity in London. So I think common sense, familiarity with the issues dictates that transition agreement is in everyone's interest, and that's why we've been saying this from day one.
I wouldn't want to bring you into political debate at all, of course, Governor, but that sounds like a rallying call against a hard exit or a clean exit or any other sharp exit.
Well, I won't. Yeah, you've rightly alerted me to be careful, but it's in our. There's a question of what the ultimate arrangement is, but having a orderly move, and I'll quote the President of the European Council, a disorderly Brexit is in no one's interest.
That's fine.
So
let me move on from that bit of fun. The PRA expects, I think, around 130 applications for authorisation from those banks to do business. Some will be allowed to retain a simple branch operation. Others, however, would require to move to a subsidiary basis. What's the balance between the two, and what's the difference in complexity between continuing, say, to run a branch operation and being required to set up a subsidiary given the circumstances of the Brexit?
Yeah. Well, we have an existing branch policy, the PRA does. And one of the simplest things, there are a couple criteria that are relevant. First, if you're engaged in significant retail activity, we will tend to want you to be a subsidiary, to be appropriately capitalized in liquidity. Secondly, if we have the degree of comfort we have in terms of the resolvability, to go to the other end of the spectrum, resolvability of the institution, so will it be an orderly resolution if something goes wrong, that will increase the prospects of that institution being a branch, as will the degree of information sharing, supervisory cooperation. I'd put it, if I could put it broadly, there's questions around how systemically important the activity is, as one consideration. The other consideration being the degree of supervisory cooperation and information sharing. So if I map that to the subject at hand, the future relationship with the EU 27, that second bucket, what's the future degree of supervisory cooperation, information sharing, the analogy of what Mr. Maltos was asking around central clearing, what's that going to look like? That will be determined, in my view, that will be determined as part of the ultimate trade and investment agreement with the EU 27. So we need to know that. And I'll finish here, if I'm an inbound firm, I shouldn't presume necessarily what that is going to be, the best outcome there. I should have a contingency plan. In fact, I have to have a contingency plan because we've asked them for it, for a world where we don't have that agreement and they're a third country branch coming into the UK. Now, we don't want that outcome. We have, not surprised, very good relationships with the European authorities. We have full information sharing, good supervisory cooperation. We think that's in the best interest of the EU and the UK, but the question is how would that be structured in an agreement, and those discussions, as you know, haven't yet begun.
I'll come back to a little more of that, but just you said in the middle of that answer about potential risks or difficulties with resolution at the worst case scenario. Do you think, given any number of the potential outcomes, that we're going to have to revisit the primary legislation on resolution if we do end up with a number of substantial institutions operating simply as branches in the UK?
Well, no, I don't think you will need to revisit legislation. We, as the PRA, and what you would look to us is to determine if that is indeed the case, whether those institutions shouldn't be allowed to operate as branches.
Fine.
That's the follows, and we have those powers.
In which case, it leads me on to the risk of disruption to wholesale banking as well, because EA firms branching into the UK lose their authorisation to do business. But these banks provide a tenth, or thereabout, of all lending to UK companies.
That's right.
So notwithstanding we don't want the branch scenario, we'd prefer the subsidiary model for the reasons you've given. Is there any immediate prudential reason why the PRA shouldn't allow these firms to continue doing business, or risk potentially the loss of tens of billions of
Well, that's the judgment. I think it would be an error to presume that we would authorize all those EU branches that are currently active here, because they're active here on a framework where we have close supervisory cooperation, we have information sharing, we have ultimate appeals to joint decision making through the EBA and other processes. I mean, those are to be used in extremis, but there is that deep arrangement that exists that underpins so-called passporting. And if we don't have any of that, then the systemicness of the branch becomes determines whether it can continue to be a branch or whether it would need to be a subsidiary. again, for completeness, we think that if we may not have exactly what we have under the current arrangements, but we could develop something that's very close to that, which would provide a great deal of comfort and would have a much more seamless transition, and keep that activity here.
Can I?
Sorry, yes, of course.
I was going to bring Roshnara in, actually, who I think...
Just
Just
one final adjunct to that then. Should an EU or EA bank have a branch here that services its customers, but it's a small part of their business, and they choose not to go down the difficult or time-consuming route of subsidiarisation, one could easily envisage, with no malice, a loss of capacity. I presume the bank are preparing to see how they can support the banks which are left, the subsidiaries which are left, to pick up the slack in that kind of circumstance.
Yeah, I think so that circumstance, and that circumstance goes both ways. Yeah. And so one of the things that's happening for a series of financial institutions that are resident here, outbound into EU 27, is their ultimate boards, are looking at the economics of splitting the business or shifting the business, incurring the costs to move to the continent. And there will be cases, there are cases where they will shut down the business as opposed to shift it. The economics don't work. And that's unfortunate, and that's a net loss for everybody concerned. I would say a general point is it's less about us supporting the banks that remain. As a general thing, that in an uncooperative outcome, which everybody wants to avoid, but in an uncooperative outcome, at least initially, the UK will be long financial services, if I can put it that way. We will have more capacity, capital, individuals, collateral in the UK, and the EU will be short financial services because not all of that capacity will be able to go across, which is one of the reasons why the entire economic impacts are greater for the UK, but from a financial perspective and a financial stability in the short term, from a financial stability perspective, they're greater for the EU than for the UK itself.
Roshnara.